Hi, and welcome to The Full Perspective. I'm Charlie Thomas, Content Director for the Insurance Insider, and each week I'm going to be talking to some of Insider Publishing's senior staff to dig into the week's most interesting stories. Today I'm joined by Insurance Insider's Editor-in-Chief, Adam McNestry. Hi, Adam.
Hi, Charlie.
And Inside P&C's Director of Research, Gavin Davis. Hi, Gavin.
Hi, Charlie. How you doing?
Yeah, good. Thank you for being with us, chaps. So this week we're going to start with some commentary from the team. It's Adam's opinion on what he terms Bermuda's Lloyd's failure. So Adam, what you wrote was pretty biting, a critique of Bermuda's track record in Lloyd's. Is it really all that bad?
Yeah, I think it's been pretty awful, Charlie. I think there's been a lot of sort of hand-wringing about Lloyd's market performance as a whole. London has passed through a kind of existential crisis over the last 3 or 4 years. The results have been awful, and the market's really struggled to work out what its value proposition is. It had terrible crisis of confidence through that period, and I think the Bermudas kind of slid under the radar because there were more prominent failures. Whether it's MS Amlin losing £500 million in a single year for its Lloyd syndicate, or some of the businesses that fell down, the Standard Syndicate, Pioneer, other entities that kind of were merged out of existence. I think that's kind of hidden the fact that when you start to dig into the numbers, almost every Bermudian that came into the Lloyd's market post KRW in that kind of 5 years where everyone moved in, and then a few years after that where the stragglers arrived, has pretty consistently underperformed the market. You've got a couple of people, kind of honorable exceptions, Talbot, Ariel, but almost uniformly apart from that, including some really quite nice underwriting franchises elsewhere in Bermuda, they just haven't been able to do it within the Lloyd's market. And I think, I suppose I think it deserves more focus than it has had. And if Lloyd's is going to resolve its problems and get back to a position of health, one of the things they need to figure out what to do is what happens to these syndicates of Bermudian businesses where it's 5 to 20% of the overall group's underwriting.
Yeah, I think that's right, Adam. And just a couple of thoughts I might add. One, there's a quote from Steve Eisman. He's a character in The Big Short, or he's a real person, he's a real investor, played by Steve Carell in The Big Short, where he says about the financial crisis that people mistook leverage for genius. And I think there's a little bit of that with what we saw over Lloyd's over a long period of time, where Lloyd's was, euphemistically a capital efficient place to do business, and was pretty over-indexed to a lot of volatile lines like cat, for example. The combination of those two things that in a good year, and quite often that means in most years, the results can look really good. But when that latent risk is exposed, things can look pretty bad. And I think you saw a little bit like a sort of golden period where the wind didn't blow, there wasn't a lot of cat, and you saw a lot of people do really well, and that attracted a lot of people to come in. The last few years have been kind of the opposite story there, where you've seen Lloyd's underperform, where there's been a lot of volatility, and maybe people are reassessing that. The other thing to say is, there's a tendency to say Lloyd's has this unique special distribution, it has the international licenses, you sort of see business there that you wouldn't elsewhere. There's kind of a problem there, which is just that might be true, but just turning up and saying me too doesn't really get you anything. And it's the same, you have wonderful businesses in Lloyd's that have really outperformed, but you have terrible businesses as well. And it's a bit, there are wonderful businesses in US specialty as well. There's nothing magical about Lloyd's, and just turning up and saying I want a piece of that doesn't get you anything. You have to bring something, you have to problem solve. And there's definitely been a tendency to think that you have to have Lloyd's in your distribution channel without thinking what you're actually getting from doing that.
I think there's also a big question as to whether you do need Lloyd's in your distribution channel as well. You said that that's a way of accessing business that isn't available elsewhere. I don't know if that's true. You can write some of those programs in the States. You can access some of that business onshore in the US. Reinsurance is a global marketplace. I'm sure there is some business that you would only see within the Lloyd's market, but you're paying a lot more to see that business. Acquisition costs are high, operating costs are high. And there are definitely people who are talking about the multi-platform players who have optionality around where they access business, who just struggle to see why they would do it through London when they could do it through a different platform.
I think that's totally right. And this is really sort of, we're talking about what was true a decade ago and what is true now are sort of two different things. And that's probably why you're seeing the strategy get reconsidered.
Okay, let's leave that one there for the time being and move on to our second topic this week, which is COVID-19 loss disclosures. So we've seen a string of announcements this week already. Gavin, what's your take on the disclosures so far?
Yeah, I think the first thing to say with anything like COVID is you should be careful not to over extrapolate from anything. Okay, this is a crisis that's still ongoing. In many ways, especially in the US, you might think of us being sort of in the eye of the hurricane here. We've had the first impact, and we've got a little bit of calm, but for various reasons, cases are going up, the hospitalization and death rate lags. So we're still very much in the middle of this, and any conclusion you make today as if it was definitive risks you looking stupid in either direction. There's a lot of uncertainty. So that's the first thing to say. But I think what we have seen from early data points in Q2 is that this seems to be less of an immediate crisis than has been made out or conventional wisdom may have portrayed. And there's a couple of things there. We at Inside P&C from the very beginning have been saying, yes, there's a lot of tail risk here. Yes, there's a lot of things that could go wrong that are low probability. And there's all these different ways of thinking about the way that you have explicit exposure, accidental exposure, and political and regulatory risk. All those things were legitimate, but that tendency to focus on this, you're watching the news every day, you're in a crisis mentality. Your instinct is to always look at what's going wrong and where you can lose money. I think that what a lot of people missed early on, and is becoming more obvious now, and we've been arguing from the beginning, is there's also a lot of offsets. There's a lot of benefits, things like auto, things like workers' comp, lots of other forms of liability lines where people they're just doing less. They're going to less places. There's less stuff happening, and that frequency is going to show up over time. We've sort of argued that it's going to be really hard to ever really mark this to market over a long time. People are going to want to recognize those gains slowly. They're going to want to recognize the pain early, because they have a balancing act with their regulators, and they want to make sure that they get that right and optimize that strategy. But what we've seen early on, we've got data points from travelers, from Hanover. This doesn't seem like that crisis quarter where everything is everything is on fire. It's going to turn the market. Paid claims are going crazy. People don't know what their balance sheets are because assets have been destroyed. This doesn't feel like that. And I think there's been a tendency to do a bit of post hoc ergo propter hoc, which is pricing is going up and it happened after COVID. Therefore, it's because of COVID. When actually, I think what you've seen is a lot of long-running trends on bad loss trends we were talking about last year. You've also seen the economic crisis impact lead to lower yields, which pressures net investment income. And yes, incremental and additional losses, especially in some classes, which are really cat-like and meaner. In contingency or something like that, this is a cat 5. So ultimately, it's another factor that's driving a harder market. It's an important one. It's combined and intermingled with the economic crisis in a way that is complicated. And if you are over-indexed to some specialty classes, it's going to be really meaningful. But if you're a vanilla US insurer, I think the early data points we're saying is maybe this isn't the big deal that some people have made it out to be.
I suppose what's interested me
with the caveat that it's still playing out, and that it could still change from here.
Right, I think it's very important to say the game is still being played, and there's some huge swing factors, whether it's what ultimately happens around BI as a result of the litigation, whether it's what happens with comp. We just don't know on those things yet, right? I think what's interested me is that it feels like there's kind of two tracks that are emerging here. On the one hand, you've got the kind of the Chubb approach. They put up a big reserve. I think it was 1.4 billion, and they were still talking up the event, and I think playing down the frequency benefits. And then you had Travelers, the Hanover, to a degree, CNA and the Hartford on the other side of things, who seemed to downplay the loss. And the messaging seemed to try and be, the messaging to investors seemed to be more about like, don't panic, don't worry, we've got this. And I suppose what I'm wondering here is the degree to which that is just a straight reflection of business mix and the extent to which you see it as being something that kind of reflects management tactics around how you deal with this event. I mean, reserving is always somewhat subjective, and this is a time where the uncertainty is such that it's way more subjective than it normally is.
Yeah, I think it's a great point. I think there's multiple elements here. One is mix. If you have a big auto book, you're looking very different if you're commercial and reinsurance and it's specialty focused. Mix is a big factor. But to your point, stuff around your stability going in, your relationship with your stakeholders like rating agencies and investors going in might change the way you try to take pain early, or the way that you try to defer that, how you try to index relative to peers. You will definitely, I think, look at Chubb. They put an extra 100 million, I think, of just plain IBNR for uncertainty. You've seen across a number of these releases, people taking bad news on the molestation cases, for example. Right. This is, the proverbial good quarter to take some bad news, because people are expecting bad news one way or another. And if it's not manifesting in COVID paid losses right now, well, you may as well book some other reserves. And, from the beginning, we talked about this being a get out of jail free card on frequency in lots of lines, where you can kind of catch up to trend where you've gotten behind. And you might see some of that going on, where people are like, well, there's a lot of crisis, expectations are low. Let's find where we can throw in that bad news, and we'll keep some good news. But, to your point, every company is going to have a sort of different tactical approach to the extent that they can. And this isn't, people often say this is cynical and like actuarials or professionals doing the best. Totally true. But, there's so much uncertainty, your point, that there is just a wide range of how you play this game. And right. There is a wide scope to be more conservative or less conservative.
We should wrap it up there. So I will say thank you to Gavin and to Adam for joining me today. Thanks very much, guys.
Thanks, Charlie.
And thank you guys at home for watching. Until next time, stay safe, keep well, and we hope you'll join us again for another episode of The Full Perspective.